In this workshop, we're going to talk about, are you too old for downturns? When we see market fluctuations, market volatility, it is unnerving, to say the least. So a lot of times what happens, especially as we get closer to retirement or in retirement, we say to ourselves, I'm too old for this. I can't do this anymore. I've got to go to cash or something like that. So typically what happens is it causes us to make decisions about our investments that we might not have made had we known a little bit more about how markets work. And I want to deal with that right now because a lot of people do that. They get to retirement, they go, I'm just too old for downturns. And let's put this all into perspective. If we look at somebody that is age 65, let's say, and say, well, let's look at the life expectancy of a male that is age 65. It's about 18 years. Okay, so I want you to just kind of keep these numbers in the back of your mind as I go through this. If a female, it's 20 years, a little bit over 20 years life expectancy if you're age 65 now. Joint life expectancy would be 27 years because, of course, you've got two people now, and the likelihood of somebody being around longer would be higher if you have two people. Now, if we're looking at somebody that's age 75, for men, it's 11-year life expectancy, females about 13 years, and joint is about 18 years. Now, if we age 85, we still have life expectancy. And interesting, what happens is if you've made it another 20 years, you still have more life expectancy because you've made it past a period of time where some people would have obviously passed away. So men, life expectancy, if you're age 85, got another 6 years expected, about 7 years for women, and 11 joint life expectancy. So just keep these numbers in the back of your mind as I go through some information about the stock market. Now, why do we own stocks? Well, the biggest reason you want to own stocks, as you always hear me say, is protection against inflation. What is inflation? Prices going up. Who's raising prices? Companies. What do you own when you own stocks? You own the companies that are raising prices. Now, if we look back through history and say, well, what if we put all our money in fixed income investments? How long does it take for our money to double after inflation? About 150 years at a 0.4% return. And you look at right now, when we have inflation numbers much, much higher, you're actually having a negative rate of return. So forget about money ever doubling at the current rate of return that we're seeing in fixed income investments after inflation. But with stocks, it's somewhere in the neighborhood of 7, 8, 9 to 10 years for money to double after inflation. So hence, that's the reason we own stocks even into retirement. It protects us from, if you look back in the 1970s, you could live off of about $7,000. Now perish that thought. You have to have about $70,000 to do what 7 did back at that point in time. Now, there is a statistic, and I wish somebody would update this statistic, but it's probably still pretty doggone close, if maybe not even a little bit shorter, just based on my viewing things myself. But back a while ago, the New York Times did this article about market downturns, and they looked at the statistics on how long it takes for the stock market to recover when we go into downturns. And they said, count the days, not the years for market pullbacks. In other words, for markets to recover from downturns. So remember those life expectancies? You have to look at this and go, wait a minute. As long as I live another 111 days, the average amount of time for the market to recover, it would have recovered, and probably chances are I might be around for it. Now, if we look at the numbers a little bit more closely, and you see this far right-hand column, it shows you the amount of time. First, you got the just to the left of it, peak to trough. So when the market went down, how long did it take to go from its peak down to the trough or the bottom? And then the trough was back to where it was again before. And you see, again, on average, it's days. The max from this period of time for the S&P 500, it was literally since 1965, 321 days was the longest period of time that it took. So you look at that again, not years, but days. And we look at declines in general and we go, man, they're just unnerving though, Paul. They're just unnerving. Well, yeah, if you actually look at the data, you see that they may be unnerving, but they're pretty normal. Since 1946, if you look at the amount of downturns that we've had that have been between 5 and 10%. So a portfolio dropping between 5 and 10%. We've had 84 of them. Literally, on average, it takes about a month to recover. If we look at 10 to 20% downturns, now you talk about a bit more unnerving, a 10 to 20% downturn is a lot more unnerving. Well, we've had 29 of those. That's a lot. So we look at that and go, well, how often is that? Well, every about 3 years or so, somewhere in that neighborhood. And we see that it's pretty frequent. And on average, it takes about 4 months to recover. 20 to 40% declines, 9 of them. That's a lot in that period of time. And 14 months. Again, it's not years, months. And 40+% downturns. We've had 3 of them. And that has taken a little longer to recover from. But it's not in an unbelievable amount of time by any stretch of the imagination. But there have only been 3 of them, since that period of time. And that's only one asset category. Remember, you didn't own anything but big US companies. You didn't have any bonds in your portfolio. You didn't have any small companies. You didn't have any value. And what we know is that when we diversify between these various asset categories, we don't have the amount of time it takes to recover. And we've got someplace we can pull income from to give us time or buy us time for markets to recover. More about that in a second. Because if you look right here, a 95% stock portfolio, and you look at what's one of the more nasty downturns that you've experienced in recent years, probably chances you're going to say the banking crisis was really nasty, 35% downturn. And you'd be right, it was a pretty nasty downturn. Remember it well. And remember the TARP and how the troubled asset relief program and how banks were going under and how people were buying houses with money they didn't have and all the problems and Geithner coming out, the Treasury Secretary talking about the banking system, and Bernanke coming out and talking about, and here's a guy that was an expert in the Depression, was the Fed chairman at the time. And what happened was this. You look at it and you say, oh, well, there we go. We were recovered literally from June 7th, where the market started down, by April 2011. That was a good long period of time. But remember, this is an all stock portfolio, and somebody in retirement would not be typically in this type of an asset mix. So what we do here is we look at a portfolio that's 60% stocks, 40% bonds, which would be more in keeping with what somebody might have in retirement. And you see that the recovery was much shorter and the decline was much less in this particular instance. So you keep in mind that that is something that we mitigate with asset portfolio and how we put the portfolios together, an asset mix in putting the portfolios together. Now, this is a workshop. This isn't the first time I've taught this workshop. Some of you may remember we had, good grief, I think it was on Facebook, 60, 70,000 views on the time that I did this workshop. A lot of people were very, very interested in it. And I was telling the guys, hey guys, let's go back and look at the last couple of times that I taught this workshop. And we did. And what I did is I said, look at when I taught it last and what the market has done since that downturn. And this is what we found. Small value stocks up about 40% in the 2018 version of this workshop. Small company stocks about 40% return since then. About over 35% for large value and about a 60% return for large cap. And you see all the asset categories, international value and international large value, all pretty significantly recovered from the time that I taught this workshop first. And the reason I taught it the first time was because we were in a major downturn and it was scary. How about the most recent major downturn that we've all been through? You remember this one well, 2020, March. I had to teach the workshop again. Yes, and I had great timing when I taught the workshop. I taught it on March 20th. So what we did is we looked at March 21st and looked at what happened in various sections of the market since then until now. And you see, good grief, small value stocks up 160%. So no, this is not an indicator for future market direction. Don't take it as that. Because Paul's teaching this workshop, don't take it that way. But just the point I want you to get, markets go through this, and companies are run by people that when things get tough, when things get hard, when they get scary, companies will do one of two things. They're going to either figure out how to sell something else that isn't selling now, they're going to have to figure out how to increase sales, or they're going to decrease their expenses. But no matter what, companies will figure out how to get back to profitability in order to increase their stock price. Because if they don't increase their stock price, guess what? There are a lot of heads that will be rolling, and they won't be working at those companies for long. And the CEO will no longer be in charge because they will get fired. That's how things work. Now, if we look at headlines and we look at what's going on right now, we see this kind of stuff. More trouble for a troubled market. Stocks take a sharp dive. Oil prices surge after Russia attacks Ukraine. Scary headline. Global stocks plunge as Russia attacks Ukraine, and oil rips past $100, and you're going to be looking at higher prices at the gas pump, and the Dow falls 750 points. And I mean, look at that stuff and you go, man, my brain is going into overdrive, fight, flight, or freeze. And that's how our brains work. Fight, flight, or freeze. Typically, the cognitive part of our brain doesn't kick in when these kind of things happen. So we don't necessarily tend to act rationally when scary headlines and scary things like this happen. We tend to gravitate to the negative news, and the media knows that. They know you will tune in if the news is bad. We know that what happens with people is you have differing levels of attunement. We tend to tune into things that are negative because we are more driven to try to preserve ourselves or self-preservation than we are driven toward gain. So because of that, media negativity tends to attract more attention. When the news is positive, we know from research that people will not tune in. So you better believe it, the media loves it when the news is scary and negative. Now, let's go back to that life expectancy. We've been talking about how quick markets have recovered from downturns historically. And you may say, well, I've got a short life expectancy though, Paul. Well, then in that case, does it really matter? I mean, literally, whatever assets you've gained are going to go to heirs if your life expectancy is that short. Now, if you've got a long life expectancy, well, that's why we own stocks, to protect us from inflation. And quite frankly, the fact that the dollar keeps depreciating in value, if you have all your money in CDs and fixed income investments, your money is dropping in value daily because of inflation. What's everybody talking about? Inflation. What's inflation? The depreciation of the purchasing power of the dollar. Now, Paul, what if the stock market goes down and it just never recovers? I mean, what happens if that happens? Well, I want you to think about this some. If the market goes down and never comes back up, what does that tell us? That tells us that earnings went away because stock prices are based on earnings. Now, if earnings go away, what else goes away? Taxes. If you don't have any earnings, there's no money to tax. If taxes go away, what else goes away? The government. And some people may say good riddance, but the reality of it is, if you're putting your money in banks, you're putting money in treasury bills, that's what's backing it. And that's what goes away if earnings go away. So everything is built on the stock market, if you think about it. And if that happens, we got bigger problems. Now, look at the life expectancies. For most people, your life expectancy is significantly longer, because this is years now, this isn't months. It is significantly longer than it takes for historically markets to recover quite well from downturns. But Paul, this one's different. It just feels different. I mean, you got Russia going into Ukraine, you got China and Taiwan, and you've got, possibility, would they went into India before, would they go and do this? And I go, well, you know what? If you look back at history, you'll find there's been a lot of scary stuff. I mean, we look back at the Great Depression and we see that Wall Street was in a panic as stocks crashed. We see the stock market panic, and panic begins with a crash in 1929. And then all of a sudden what happens is we got poverty everywhere. And what happens? There's a guy not named Putin, but named Hitler, who decides to take advantage of what's going on. And then to make things even worse here in the United States, we go and top it off with a dust bowl. And we couldn't even get crops. We couldn't, so we're talking about being able to sustain ourselves and feed the country. And we have a dust bowl to make things even worse. Well, I don't know. This is different. People that lived through that, they were saying the same thing. This is different. And then you go forward, and you look back at, we've got Russia has atomic bomb, and then you're getting into World War II, and we're worried about atomic blasts and nuclear anxiety returning to America. We could wipe out the entire world with a new technology. This is different. And you can bet your bottom dollar that when this stuff came out, people were saying, this is different. Or how about the crisis in US energy? Remember, we had odd and even days going and getting gas at the gas pumps, and Jimmy Carter sitting at the Oval Office, with his thumbs together going, I don't want to say twiddling his thumbs, but he was just going, look, we're running out of oil. We're running out of the very thing that drives our economy. And you can imagine being an investor going, whoa, this is different. Or this in the 1970s, we may be talking about global warming, global cooling, climate change, and all of that stuff. Well, you may or may not remember that in the 1970s, we were going through a global ice age. And you know what? Here's what the deal was. Science and mechanics said it was imminent. And the space satellites show that the ice age was coming fast. You're watching this stuff going, yeah, this is different. Or the population boom, and we were going to have to reduce the population somehow. How are we going to feed all of these mouths around the world? We've got to do something about this population boom. And there were a lot of people, I remember it very, very well, and a lot of you probably remember it, how scary it was when they were talking about how the population was going to overwhelm the globe, and we weren't going to be able to feed or care for these people. And Time said, it's the end of the world. I mean, panic, don't panic. And of course, the media likes you to panic because it sells magazines, whether they believe it's the end of the world or not. But Y2K was what was going on, and that was going to end the world. And I did all kinds of workshops on it back then, talking about Y2K, what is going on, and it was big nothing, right? And then we have 9/11. And US soil, we hadn't had an attack like this since Pearl Harbor. And all of a sudden, we're looking at the trade centers coming down and hijacked jets running into these towers. And we were going to be at war again. That was different. World War III, some were saying, was upon our doorstep. Heard that lately in the media at all? World War III? You probably have. And then we had this poll, 1 in 7 thinks the world is coming to an end. 1 in 7 people, that's not insignificant. We're thinking that the world was coming to an end. It reminds me so much of when I was a kid, loved watching The Twilight Zone. And they were enamored with the idea of the end of the world. How many shows did they have which were based on global thermonuclear Armageddon coming to the doorstep and how humanity would react to it? A lot of their shows were based on this idea. And then they also had this other thing that they were really enamored with. You may remember, aliens coming to take us away and invade our planet. So sometimes some things change and some things just never change, right? Now, hint, let me tell you something. It's always different. It will always be something different. We just don't know what it's going to be. One of the things we can kind of keep in the back of our minds is somehow, some way, we as humans, we always figure out a way forward. We always, if you're running a company, if you're running your household, no matter what, you're always trying to figure out, how can I recover from whatever I'm going through? And how can I move forward and move ahead and advance, not just get back to where I was, but advance from wherever I am. If you look around long enough, you will find that there is positive information all over the place. It's just not necessarily headline worthy because the media doesn't make as much money when they talk about positive news. Negative sells better every time. And I hope this has helped put this whole idea of it's different, the market downturn and market Armageddon, put it all in perspective for you.